In this video, we're going to talk about four things. What is life insurance? What type of life insurance is out there in the marketplace? How can I use this cash value in the life insurance product? It's essentially a savings component. And, how does this cash value, how do cash value loans work? What can I use the money for? So let's start off with what is life insurance, just a baseline definition for everyone. And this is a quick search on Google AI. Life insurance is a financial agreement that pays out money to your beneficiaries after you die to help with the expenses such as burial bills and education. Some policies may also provide benefits while you're still alive. And that's what the focus of the remaining part of this video is, more of the benefits out there that you could use when you're alive. Now, most people, when they think about life insurance, it is that death benefit protection that you see in commercials all the time. And that's essentially the cornerstone of life insurance, to be there in time of a catastrophic event, in time of your death, to support your family. You put money aside in case that event happens prematurely, and your family can stay in the same house, go to the same schools, their day-to-day lifestyle. You're not around, but besides that, it's not impacted. So that's the cornerstone of insurance. And there's two types of insurance. There's term and permanent. And term insurance is what you see promoted most on TV. That's the temporary insurance. Most products are anywhere from 10, 15, 20, 30 years in duration, where you pay an annual or monthly premium for that long. And as long as you continue to pay that premium, the death benefit coverage is valid. There's no savings component or cash value in these policies, so your premiums are a lot cheaper compared to permanent products. And that's term insurance for you. The next main product category is permanent insurance. And there are essentially four product categories in permanent insurance. You have whole life, guaranteed or fixed universal life, indexed universal life, and variable life. And think of whole life that product's been around for hundreds of years. And that product, it has the most guarantees in it, whereas you pay a fixed premium for, to a certain age, or maybe just 10 years or 20 years, et cetera. A lot of products out there have different flexibility on how much you want to fund it soon versus later. And based on that, there's usually a dividend in play. And you could see in your kind of illustration on how the product grows over time. Next are more of your flexible type of premium products. Those are your universal life products. These products came about in the 1970s, 80s, and 90s for index. And in this example, fixed universal life usually has a credited rate that, the life insurance companies varies each month, quarter, year. And index is an opportunity to earn maybe a little bit more. The interest credited rate is usually tied to like an S&P 500 index. And if the index return, 15%, you might get that 15%, or maybe it's capped at 10. However, the S&P index went negative, you'll still get 0 or 1% credited to it. You won't get a negative number. And then the most, call it, risky to the policyholder is variable universal life. It has great potential upside, however, all the investment risk is with you, the policyholder, because you might put your money into a certain mutual fund or index, and the performance of your policy, especially the cash value performance piece, relies heavily on the investment decisions you make and not the insurance company. So just think of it here from left to right, as from whole life to variable, from the most guarantees to the less guarantees. And then, ultimately, permanent insurance does two things. It protects your family just like term insurance does. However, you're also adding the savings component as well that a lot of these policies have. And the two main types of companies out there when looking at permanent insurance, you have mutual companies and stock companies. Stock companies are the ones that are listed as a publicly traded company, whereas your mutual companies are more private companies. And mutual companies if I was to buy life insurance in the policies that I do own that are permanent, I lean towards the mutual type of companies out there for the long-term view and thinking that they have. Next are uses. How can I use a savings component while I'm alive in my life insurance policy? I've been paying premiums for 5, 10, X amount of years. I have a healthy buildup of this cash value or savings component. Think of it that way. What can I do with the money? And am I allowed to touch it or to just keep it and let it grow? And the short answer is you could do anything really with the cash value. The life insurance company's not going to ask for you what you're going to use the money for. If you ask for a loan, it's your money. But you could use it for numerous different things. There might be emergency funds needed. There might be an investment opportunity in a real estate property that you want to take money from your cash value, buy that investment property, rehab it, and then resell it, put the money then back in your cash, put the money back into your insurance policies and collect the profits, or use the profits then to pay future premiums from the policy. So there's numerous uses that you could use it. And usually when you um, usually when you have enough accumulated cash value over time, that's when you have more and more options on what to use it for. Earlier years of a life insurance policy, your cash value might not grow as much because a lot of the money that you put into the policy is more to cover the death benefit protection. And then lastly is, how does cash value loan work? And you could basically call up, once you have a policy in place and you have a healthy cash value balance, you could call the life insurance company up, or some companies allow you to do this online now too. And you just fill out a form essentially, or they do it over the phone for you. And you usually have your money in a few days. And from there, you could get a check or do a direct deposit if they have their banking information. And then a lot of policies too, even though you're taking money out of your policy, you might be charged like a 5-6% loan rate. Life insurance companies usually declare that rate annually or quarterly, depending on type of product. However, the kicker here is that money that let's just use a whole life product as an example. If you take a loan of $50,000 out of your policy, you might be charged 5% interest on it. However, that 50K still earns dividends on that policy, and that might earn 4.5%. So the net loan cost is essentially only 50 basis points. And usually a lot of companies have, the longer you have the policy, like after 10 years, it's essentially the credited rate on the dividend that you have for the policy offsets the loan interest, and it's essentially a 0%-ish loan. So hopefully this video was helpful explaining the different types of life insurance and how this cash value work. If you have any questions, drop them in the comments section. If you got value out of this video, please smash the like button and share with anyone that you think that might help them. Thanks and have a great day.